Hello, my name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited. And here is your weekly technical analysis of New York and London sugar markets. However, before we start, I just wanted to let you know that no AI, that is artificial intelligence, was ever used in the composition, production or recognition of any of the patterns, levels, analysis or any related items on these my charts. This was all authentic intelligence, all my own original work, as I think you deserve to have that. So with that.
New York, ice raw sugar in New York. The main pattern here since September 2024, so for well over a year and close to a year and a half, has been, though I'm now starting to look at another pattern, has been, despite being breached and repaired, the dark blue September to December 2024 bear channel, currently 919 to 1421, which developed into a descending expanding wedge pattern. We're at this time resting on top of the dark blue upper trend line, and have been throughout most of January, as despite all efforts the market still will not let go of this pattern. 2 weeks ago was the first week in which prices did not interact with the broken upper trend line, and I thought we might be coming to the end of this pattern, but no, last week became a weekly key reversal down, and we are still interacting with the dark blue upper trend line. In the meantime, the mauve medium moving average, currently at 1508, has acted as a dynamic cap on prices. The green short medium moving average, currently at 1483, started acting more as support, but is back now to being either a resistance overhead or just a nuisance. There are two other patterns that have greatly influenced this market. The first, and the one that I think may be trying to take over as the main pattern here, is the bright green late September 24 to late February 25 bearish shift pitchfork. I drew the original bearish Andrews pitchfork for this move some 45 weeks ago, as it seemed back then to be a better contender in showing the bearish angle of attack, but that did not last, and I finessed it into what we now see, the shallower bearish shift pitchfork for the same move. Today we are just underneath the bright green middle tine, currently at 1436. The second pattern is another larger bearish pattern, which I've also previously spoken about, and a good contender even now in showing the bearish angle of attack. It is the longer term bright red November 23 to September 24, similar but slightly shallower bearish shift pitchfork. On this one we're a little above the bright red middle tine, currently at 1366. We also have, or seem to have had for months now, the March 21 low in there at 1466. For the last few weeks this acted as a support, but last Friday gave way and is now resistance. Then, as I said 14 weeks ago, and I quote, "We next have support on the downside on congestion based around the significant 61.8% absolute Fibonacci line for the 21st century at 1383, which stretches from 1409 down to 1379. All that is needed for these to be tested is stabilization under the bright red middle tine." End of quote. Well, we had that stabilization between late October and early November last year, and nothing much happened. So the market started to move back up over the bright red middle tine, but was constrained in its height by, initially, the bright green middle tine, and then what we have now, the mauve medium moving average. Thus last week's weekly key reversal down has put us squarely into testing that support between 1379 to 1409. Below this, well, we really don't have that much support until around the 1248 level, and I'm not too confident about this supposed support down there as well. We also have a gap between 1336 down to 1320, dating from September 2020. So a lot depends on that congestion support between 1379 to 1409. On top of all that, October was a monthly key reversal down, a bearish factor, though, as I said 13 weeks ago, and I quote, "I can't help thinking that maybe such a pattern could be seen as a swan song. However, until otherwise, the pressure is still on the downside." End of quote. Now, even now, with the pressure so evident on the downside, we seem to have had developed a small mild halt, and this has prompted me to start labelling the action between mid-November 2025 to date as a rectangle pattern between about 1440 to 1435. We are below this right now, but if the congestion below holds and we see prices rise back up, then this pattern will have repaired itself. If it doesn't, then we have to start looking at potentials below, for primary potential in the 1389 zone and a secondary, harder to reach potential down in the 1345 zone, just above that previously mentioned gap. ICE Europe white sugar in London. After all this time, there still continues to be three features to keep bearing in mind on this daily chart. The first of the three features is the obvious broken, repaired, broken again, repaired, and lately broken, twisted, and bent out of shape. Purple, late September 24 to mid-February 25 descending expanding wedge pattern, which is currently 407.5 to way off the bottom of my daily chart. This pattern had more than the requisite 5+ touches necessary back in January last year, and had since then been severely tested on the top side, enough that I would not necessarily classify it as a descending expanding wedge pattern after February 2025, though I continue to still keep an eye on the extension to the purple upper trend line, as it is, bar some congestion at 425.5 and the November 25 low of 406.40, the nearest support stroke resistance to this market. Next, I've also asked you 40 weeks ago to, and I quote, also keep an eye on the bright pink late September 24 to mid-March 25 recently finessed bearish shift pitchfork. This is a very shallow pitchfork, and the more the market moves lower through it, the more I'm beginning to like it. And that's the end of the quote. Well, since then, the market initially started utilizing the bright pink middle tine of this bearish shift pitchfork, which is currently at 442 even, as an attractor, riding prices lower in a shallow glide until early October last year, when it commenced a steeper journey lower, such that in early November last year, the market had been closer to the pink lower tine for a while, which is currently at 383.60. However, we saw a pullback up towards mid-November last year, with the market using the congestion at 425.5 as a seeming attractor. However, that has stopped last week, as prices progressively fell such that we are today closer to the pink lower tine below than the pink middle tine above. The third feature is the break above the early September to late November 2025 bear channel. This bear channel had been excellent at showing the 2025 summer into autumn bearishness of the market, including 14 weeks ago making the lowest low since December 2020. However, that same week prices broke up and out of the bear channel, and late 11 weeks ago stabilized over it. As a result, 9 weeks ago I laid out possible targets for this break higher of a primary target X up in the 447.40 and a secondary harder to achieve target X1 up in the 454 even area. I was not too sure about these two targets, as in the past the green short medium moving average, which is currently at 423.60, had been very effective at batting prices back down, but for a while I let them stand. However, I warned last week that I might retire them as there had been no progress in achieving any of them, and with last week's push lower with a new lowest low and low close not seen since December 2020, well, they have been retired. Now, there is one further more recent feature, and this had been true to New York sugar as well as to London. It is the formation of a rectangle pattern over recent months, roughly between 415 to just under 435, or just over 435, let's say. Today we are well below this pattern, and it's appropriate to lay out some targets below. Thus, the primary target at 404.20 has already been achieved last Friday, and we have a secondary harder to reach target X down at 395 even. This is not an ambitious target, but it is nevertheless still a target down there. Sugar white premium spread. This one has been a very disappointing one, but perhaps, just perhaps, it may be turning into something useful. Disappointing not because of the market doing the opposite of what I thought the market might indicate, but because the market did nothing, or at least nothing much, for quite a while. 20 weeks ago I said, and I quote, "Things seem to be trying to resolve themselves into a pattern, end of quote. And over the intervening weeks, they seem to be doing just that, though not always the way I imagined they would, or even into a clear resolution. You see, I thought we might be moving towards, as I cautioned for a number of months, and again I quote, I have a fear, and this is a real fear, that the whole February 25 today action may be trying to form a possible diamond pattern, end of quote. I continued, and I once again quote, this would be a large pattern in time, probably from February to November this year, so that's last year, and in height, roughly between just under 100 up to 150. It's too early to say if this is happening, but I would urge you to keep an eye on such a possibility, end of quote. That possibility looked real until 20 weeks ago when the market dropped down and below what I thought would be the lower bullish trend line, highlighted in dark blue on my weekly chart. The market not only dropped below this trend line, and let's be honest, it's an unjustified trend line, but went on further to drop and close below the gold long moving average, which is currently at 109 even, stabilizing further down, dropping and closing below a new support line, the bright red neckline, currently 97 3/4, of a new, simpler pattern, which the market opted to utilize instead of the more complex diamond pattern. It became a February to early October last year head and shoulders top. The issue I had and still have with this pattern is that we are past the early stages and we really haven't confirmed a move either higher above the gold long moving average or lower, sufficiently below the bright red neckline extension, until perhaps last week. I chose 16 weeks ago to lay out some potentials below for such a head and shoulders top pattern just in case. Thus the primary target X is down in the 70 even zone, the secondary harder to reach target X1 down at 43 3/4 zone. You will easily note that the primary target X is at the lower end of the congestion seen between September 24 to January 25, between approximately 70 even to 85 even. Since then, nothing much occurred until perhaps last week. Now, this was only the 1 week, and I'm very much like to verify if this move lower is the real deal and not a false break, but it is encouraging. It all still comes down to what I said 16 weeks ago when I said, and I quote, only concerted, consistent and long-term moves over the new bright red neckline, ideally over the slowly rising long moving average, can possibly assuage the bearish potential, at least as far down as the 70 to 85 congestion, end of quote. We had in recent times been half there, half not there. And the moves over the last 12 weeks exemplified these half in, half out contradictory courses of action until last week. It had looked like indecision, but on a much larger scale, more than just a weekly chart can really show. But now, maybe, just maybe, that is finishing. This also raises a question, and it's too early to say for sure on this one, but it may be that the whole mid-September 2025 today action could be seen as a bearish halfway hesitation. If that is to be the case, then we could be looking at a move down to just under the 65 even zone. And that is something to consider.
Thank you for watching and listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and at the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Services International Limited. And here comes the final important bit.